The One Big Beautiful Bill Act has brought some amazing changes for business owners, but there are business owners that are unfamiliar with the changes and how it affects them. If you are self-employed, a freelancer, running a small business, or drive for any gig apps like Uber or Lyft, there is a tax law that already changed how much you owe, and most people running their own businesses still don't know what's in the One Big Beautiful Bill Act and how it affects them. This video is going to go through the 5 provisions that actually matter if you work for yourself, along with what changed and the mistakes that I see people making with each one. Now, before we continue, I do want to say that this video is for educational purposes only. There are numerous factors beyond the scope of this video that should be considered before anything is applied. If you would like to work with reserve tax advisors for expert guidance on anything in this video and for a customized strategic tax plan to keep your money where it belongs instead of having it sent off to the IRS, a link will be in the description for a free consultation to discuss if we will be able to help you reach your goals for both your personal life and your business. Now, let's get into the video. Let's start this video off with the big one, the qualified business income deduction. Also known as a Section 199A deduction, is one of the biggest deductions for sole proprietors, partnerships, and S-Corp owners, which allow an eligible business owner to deduct a chunk of their business income before it even hits the tax brackets. Now, that in itself sounds great, but here's what actually matters. Eligible taxpayers can deduct up to 20% of their qualified business income. That hasn't changed. What did change is that this deduction was originally set to expire completely at the end of 2025, which would have eliminated a major tax benefit for millions of self-employed workers overnight, which would have resulted in increased tax bills for all self-employed workers as well. The OBBA has made it permanent, and now there is no more wondering if Congress is going to let this expire while you question whether it's worth starting a business anymore. What makes this even better is the part that most people seem to miss, but is extremely important, and that is the phase-in and phase-out limitations have increased, and here's the part that actually changes your numbers for 2026. It means that you may be eligible for the QBI deduction in 2026 even if you were ineligible in the prior years due to your income being too high. It's well worth checking with your qualified tax professional to reassess your eligibility to take the QBI deduction for 2026. Don't assume that you're not eligible to take it in 2026 because you may just be leaving money on the table for the IRS to take when it could have gone into your pocket instead. Rerun your numbers for 2026 and check if you are now eligible for the QBI deduction. Now, this next provision we're going to be going into is for the millions of workers who are in an occupation that collects tips. As you may know by now, the One Big Beautiful Bill Act has eliminated tax on tips, which is incredible for millions of workers. If you're in a tipped occupation, and this absolutely includes a lot of self-employed and gig work, not just restaurant servers, this is the one that was all over your feed when it was first announced, and the one you were probably most excited about. But it's also the one that is the most misunderstood. Here is the fine print on the no tax on tips provision. Employees and self-employed individuals may deduct qualified tips received in certain qualified occupations. Wait staff, bartenders, salon workers, personal trainers, and many more who customarily and regularly receive tips. In a final regulation issued on April 13th, 2026, the IRS and the Department of Treasury listed over 70 occupations it considers as customarily and regularly receiving tips. But, and this is the part that most videos skip but is super important, there's also a wide range of industries considered a specified service trade or business, or SSTB for short, that was excluded from the no tax on tips, which includes fields such as health, law, accounting, actuarial science, performing arts, consulting, athletics, just to name a few. So what this means is if you are a self-employed consultant who occasionally gets a tip from a grateful client, that's great, but this deduction is not for you, even if it was considered a tip by the client. Another number you should also have in mind is the maximum annual deduction limit, which is $25,000 for joint filers and $12,500 for all other filers. As for my self-employed taxpayers, the deduction also cannot exceed your net income from the business where you earn the tips, so be sure to take that into account as well. The deduction in general also has a phase-out limitation, which starts at $150,000 modified adjusted gross income for single or $300,000 for joint filers. And here's the line that should be in every video that talks about this, but usually isn't because it doesn't sound sexy, but it's absolutely important. And that is that the no tax on tips not only counts cash tips as well, but it's also referring to only the federal income tax. You still owe Social Security, Medicare, and most state and local taxes on your tips. This is not tax-free money, but it's actually just one layer of tax removed, which would be a more accurate way to describe it. The biggest misconception is assuming that you automatically qualify for the deduction because you got the tip once. Check the occupation list and see if your occupation is included in that list that was released by the IRS and the Department of the Treasury. If you're self-employed, you should be tracking those tips yourself to ensure that you are taking the appropriate deductions if you are eligible to do so. Okay, so the third provision that we're going to be going into, it also affects millions of workers who regularly have overtime hours, but confuses many people as well. So let me get this cleared up for you. This is the no tax on overtime that was a part of the One Big Beautiful Bill Act when it was first introduced. The no tax on overtime is pretty straightforward, but the clarification that's needed here is that the no tax on overtime only applies to the half portion of the time and a half overtime pay required by the Fair Labor Standards Act. So what this means is if you're getting paid a time and a half, the deduction only covers the extra half of that pay, not your entire overtime paycheck. And this is the part that most workers misunderstand and are often caught off guard when they see that they owe more than they expected because they were not understanding this correctly. It's also important to know that the maximum annual deduction is $12,500 or $25,000 if you're filing jointly, with the same modified adjusted gross income phase-out thresholds as the tips deduction. Any amounts over the maximum annual limit will not be eligible for the deduction, and you will be paying the full tax on it. The mistake that small business owners make is assuming that this is a set it and forget it. If you have employees earning overtime or tips, you need a system tracking this to ensure everything is being tracked properly and you have the appropriate documentations for your tax filing. Don't start this in March when you're scrambling to get everything together to file your tax returns. Now, another big part of the One Big Beautiful Bill Act is the reinstatement of the bonus depreciation. 100% bonus depreciation is back and it's permanent. The OBBA has restored 100% bonus depreciation for qualifying business assets, which were originally scheduled to expire. However, it's important to note that the 100% bonus depreciation only applies to assets purchased and placed in service after January 19th, 2025. What this means is that if you've purchased an asset before January 19th, 2025, it's not eligible for the 100% bonus depreciation and will be subject to the lower bonus depreciation rates. Now, this is great news for all business owners, but it doesn't mean anything if you don't know what bonus depreciation is. So let's go over what it is so you can understand why this is such a great change. When you purchase eligible business equipment, certain vehicles, or other qualifying property for your business, bonus depreciation allows you to depreciate the entire cost in the first year you acquire and place into service instead of spreading it out over several years with the traditional depreciation method. Now, to visualize this, let's go into an example that shows how this works. If you buy a $3,000 computer for business, which usually has a 5-year useful life, bonus depreciation would allow you to take the full $3,000 in depreciation in year 1 compared to depreciating only $600 for 5 years if you were to use the traditional straight line method. If you've been putting off buying an equipment because you didn't want to wait years to depreciate it, That just changed, and you'll be able to deduct it in the first year if it is an eligible asset. Now, here we are at the last provision that we're going to be going over for business owners, which is the Section 179, which is also related to depreciation like bonus depreciation, but differs in certain ways. The One Big Beautiful Bill Act has increased the annual Section 179 deduction from these new limits would apply to assets placed in service in 2025, and you can expect these numbers to be adjusted for inflation in the future years. As mentioned before, while Section 179 and bonus depreciation are similar in some ways, here are some ways on how they differ. Section 179 cannot exceed your net business income. What this means is that you cannot use Section 179 to create a net loss, whereas bonus depreciation is able to do that. Section 179 is an election that you must make if you want to use it, whereas bonus depreciation is automatically applied unless you opt out of the bonus depreciation treatment. Bonus depreciation can only be applied to properties with a useful life of 20 years or less, which means property improvements, which are usually more than 20 years, would not qualify for bonus depreciation, but would qualify for the Section 179 treatment. Section 179 and bonus depreciation are similar but serve different purposes, so it's important to understand the difference to be able to use both to receive the biggest upfront deduction that you can. The One Big Beautiful Bill Act has brought incredible changes for business owners and millions of workers in the United States, but that only matters if you actually understand and use the benefits in a strategic manner. Be sure to recalculate your numbers, since the new limits, thresholds, and the adjusted figures may just be enough for you to be eligible for tens of thousands of dollars in tax savings that you might not have been eligible for last year. Now, we talked about a lot of the provisions in this video, so let's do a quick recap of the ones that mattered the most. QBI deduction is permanent and here to stay for good. The phase-in and phase-out range has been increased, so you may be eligible for the 20% QBI deduction even if you were not eligible in the prior years. No tax on tips, only exclusive from the federal income tax. You still owe Social Security, Medicare, and most state and local taxes depending on where you live. There is also a phase-out limit as well as a maximum annual deduction limitation. No tax on overtime, only applies to the overtime portion of the pay, not the entire paycheck. There is a maximum annual deduction limitation and it only lowers your federal income. You may still owe other taxes on that income similar to tips. 100% bonus depreciation is back for good, but that depends on when the asset was purchased and placed into service for eligibility. Last but not least, Section 179 limitations and the phase-out thresholds have been increased. We've learned a lot today, and hopefully this gives you a better understanding of some of the provisions of the One Big Beautiful Bill Act that actually matter to you as a business owner. If this video has helped you out, we would really appreciate if you would like and subscribe, as it really helps bring more content just like this. Did you know everything in this video, or do you have any questions on anything that this video covered? Let me know down in the comments and I'll be sure to get back to you as soon as I can. Thanks for watching this video, and I will see you on the next one.